in part 2 of chapter 4, this is long-term and short-term planning. We're going to pick up where we left off last time, and we're going to talk about interpreting the cash flow statement. So this cash flow statement is going to allow financial managers to better analyze the inflow and outflow of the company's cash. And managers need to pay special attention to major categories of the cash flow and to the individual items that make up the cash inflows and outflows of the categories, which would be operational, investments, and financing. So analysts are also going to use this to evaluate the progress of the company, the risks of the company, and the effectiveness and efficiency of the financial managers. So the financial manager is going to want to prepare a financial statement, to help develop what their financial projections are going to be and determine courses of actions if they need additional cash flow. Now, one thing that we could do, we want to look at the operating cash flow. So to calculate the operating cash flow, we first have to look at what we call NOPAT, or net operating profits after taxes. So operating cash flow is one of the, I think the most important cash flow, because it's from the operations of the business, from the selling of the goods and services. If a company does not have a viable strategy for producing profits from the operations of the company, then what's the point of being in business? Now, like I mentioned before, some companies like Netflix and Amazon had very long time horizons of turning the operations of the company profitable in the early years of the company. And some companies are profitable right away. Some companies are profitable in the midterm, and some companies may be profitable more long term. But managers need to understand that and express it to their investors. Now, as far as operational cash flow, this is something that we're going to define as excluding interest expense, because we want to have a measure that captures the cash flow generated by the company's operations. And if you're buying a company, you would want to be more closely look at the operational cash flow. We don't really at this point want to, be influenced by how those operations are financed. So the first step is to calculate that NOPAT, net operating profit after taxes, which is going to equal earnings before interest less taxes. Just like it says, net operating profits after taxes. Now, so we're going to take, how we calculate is we're going to take our earnings before interest and tax, sometimes called the operating income, and we're going to multiply it by one minus the tax rate. So this is going to be, if we add depreciation to this NOPAT, we're going to get our operating cash flow. So again, the EBIT is what really is operating income. Multiply this by 1 minus the tax rate, and this will give us our net profit after taxes. Now, if we add depreciation to that, we're going to get our operating cash flow. So the operating cash flow could be NOPAT plus depreciation, or operating income, abbreviated as EBIT, earnings before interest and taxes, times 1 minus tax rate plus depreciation. Now, we have to remember that in 2017, I mentioned this earlier, that the Tax Cut and Jobs Act, the top marginal rate of corporate tax fell from 35% to a flat 21%. For sole proprietors, and partnerships, individual tax rates apply. So this corporate tax rate of 21% is only for corporations, not for proprietorships or sole partnerships or partnerships. Sole proprietorships or partnerships. Only the 21% is only for corporations, and this is why our tax code is so confusing, because things are so inconsistent among businesses even. Okay, so let's talk about what this operating cash flow represents. This represents the cash flow that the business generated by just operating the business without looking at money being borrowed or other investments. So this is truly a real indication of how valuable the business is. But we take it a step further, and we're going to go into calculating the free cash flow. So the free cash flow is going to represent the cash available to investors, and this is going to and the providers of debt, which could be also known as creditors, and the investors can be known, if they're equity investors, as owners. So after the firm has met all the operating needs and paid for the net investments in fixed assets and the investments in current assets, so the concept here is that the free cash flow from the firm, or the free cash flow that the firm can distribute to investors. It basically means this is after the firm pays for the necessary fixed and current assets to run the business, continue to run the business, then the remaining cash flow is going to can be distributed to investors as dividends. So how do we calculate this? It gets a little bit more complicated, because what we're doing is we're going to start with the operating cash flow. We're going to subtract out what we call the net fixed asset investments, and we're also going to subtract out the net current asset investments. So that just basically means for this particular period, how much money, additional money, do we invest in the fixed assets and the current assets. So if we subtract that from the operational cash flow, we get the free cash flow. So this is the unburdened free cash flow that can be, if chosen, to be distributed as dividends to investors. Now, how do we calculate the net fixed asset investment? It's going to be the change in fixed assets plus depreciation. And the net current assets is going to be the change in current assets minus change in accounts payable plus accruals. Now, keep in mind that when we say change, that's year-over-year change from this year to last year. That's a change we're looking at. Okay. So let me just talk a little bit more about this. So when you're calculating the fixed assets, it's going to decline by the amount exceeding the depreciation for the period. So that would be negative. So a negative represents a net cash inflow attributed to the firm selling more assets than it acquired. So that net fixed asset can be a negative, which would be, in the way we're looking at this, a cash inflow. And the net current assets, abbreviated as NCAI, is going to represent the net investment made in the firm's current operating assets. So net refers to the difference between current assets and the sum of accounts payable and accruals. So notes payable are not included because they represent a negotiated claim against the firm's free cash flow. So if we were to calculate the NCAI, we would take the net change in current assets, if current assets increased year over year, minus the change in accounts payable plus the accruals. So accruals are basically money that we have accrued but we owe. Okay. So it's there like a liability. Okay. Now, and this would represent, again, basically what we're talking about here is money. So we have the free cash flow, the money that the business generated. If we look to the investments we're going to need to keep the business in business, change additional fixed assets, maybe new machinery to be purchased, additional current asset, maybe new inventory to be purchased. We subtract that out of the operating cash flow when we get the cash flow that are free of the operational requirements, and this is cash flow that can be given to investors. Now, continuing on to the cash budget. So the cash budget is now how we're going to formalize our inflows and outflows of cash over time to give us an estimate of what our short-term cash requirements are going to be. So in your own personal life, you might have a cash budget for the week. And you might say, I plan to eat out on these days. I plan to go to the movies on Friday. And I plan to buy somebody a birthday present. So this would be the cash outflow for the week that you should calculate and make sure that you procure enough cash to fund these activities for the week. So if you had a cash budget, you get the basic understanding. You want to look at your cash inflow, maybe income from work, and your cash outflow, what you're spending for the week. And the balance would either be a negative or a positive balance, meaning if it's negative, you're going to have to get some additional funds, maybe take them from savings. Or if you have a positive result in your cash budget, maybe you have some additional leftover funds for the week that you can reinvest into your savings account. So the goal here is to use cash budgets to help us plan. Now, the first step is a sales forecast. Just like in the financial simulation we're using in this class, you have to develop a sales forecast for each of the units that you're expected to sell the next year. And it's a tricky process because there's a lot of inputs that go into predicting the sales for the next year. So you have to think, for each business is different. So the key inputs for each business can be slightly different depending on what type of business they're in. But, the financial planning process, we're going to think about what is it that's going to affect our sales forecast. So if you talk to the marketing department, they're going to play a major role in gathering information through data to help figure out what the projected sales are going to be over the coming year. Also, you need to know in your sales forecast, are you changing the amount of money you're spending on advertising and marketing of the product? So if you're doubling your advertising and marketing budget, it's safe to assume you'll be selling more than usual. So that should be factored into your forecast as well. So the basis of the sales forecast, the financial manager, along with the managers in sales and marketing, they're going to use this. They're going to use a bunch of key inputs to help determine what the forecast should be, because the financial manager needs to take this information to create a monthly cash flow that's going to result from the projected sales that he or she is going to need to outline to production, inventory manager, and sales. Basically saying, if marketing and sales get together and give the financial manager a forecast, they can then extrapolate that to, okay, this would translate to how many people we need hired, how much equipment or factory space we need. This will be how much money that we're expecting to see from these sales. So they may have to borrow money now to finance the operational activities, to buy the inventory, to hire the people, to get the operational equipment, to make the products. So you can see how the sales forecast is tied into all of that. So that the financial manager is going to determine the level of fixed assets that are going to be required and the amount of financing that will be needed to support these new sales goals or sales forecasts during that particular year. Because it's not an easy thing for a company to double or triple their business. So even though the sales forecast may be doubling the business, it still takes a lot of effort and financial know-how to get to the company's position where it can actually manufacture double the goods for sales, and the hiring the right personnel to get those sales through the marketing channels into the stores to be sold. So the sales forecast is really going to be analysis of probably two big areas. You broke the sales forecast out into two big areas. It would be an external forecast and an internal forecast. So this external forecast would be the relationship between the firm's sales and key external economic indicators, such as the growth of the economy. It depends on where your products are. If your products are furniture, you may want to look at new housing starts or new housing sales. If your products are automobiles, you might want to look at disposable income, consumer confidence. So the external forecast is really looking at how your product fits into the economy and how the economy will affect the demand for your product. There are some products where the economy doesn't have too much effect. So typically, products that are free of economic increase or decrease would be alcohol, medications, tobacco, where these things are going to be purchased regardless of the condition of the economy because of the nature of those products. Other products like sailboats, cars, luxury goods, buying of houses are going to be closely tied to the overall economic forecast and perception of the economy in people's minds. So some products like automobiles are very closely tied to the future economics of the overall economy, and some products aren't. So you have to know where your products lie in between. For example, during an economic downturn, big expensive restaurants or restaurant chains that are expensive see a reduction in sales, while inexpensive restaurants, say like a Taco Bell, see an increase in sales as people are trading down from more expensive restaurant experiences to less expensive restaurant experiences. Now, the internal forecasts for forecasting sales are going to work as a sort of a consensus of sales through the firm's own sales channels. And it's sort of an approach where the managers are going to have to come up with an idea of where the sales are going to be based on inputs from their salespeople, inputs from their customers. They may have backlogs that they're maintaining, and this all helps to make a more accurate sales forecast for the coming year. So if you're an automobile company and you know that the big rental car companies may have reduced their fleets of cars during a bad economic period and now trying to increase the number of cars in their fleets to rent because times are better and people are traveling again and renting cars, then you should factor that into your forecasts. Some companies will actually even get commitments for, I know airplane manufacturers like Boeing will get commitments from airlines on the number of airplanes they plan on buying ahead of time. So that's what we call sort of a backlog of products we know we have contracts to sell, and we're going to deliver them in this year. So each business is different, and they're going to use as much internal information. Perhaps they're using information from past sales of the product through the past months and past multiple years to better predict what this year's sales would be. So there might be a product that grows at 2% every year pretty consistently with the population. That would be built into the sales forecast. But no matter how you get there, the more accurate the sales forecast, the more accurate the cash budget's going to be. And using a combination of external, internal forecasting to help better, more accurately forecast the products. Now, for a lot of companies, if they are making new products, maybe they're making 10 new products, they might be retiring 3 older products, it gets more difficult because now we have new products, we're not sure how they fit in the marketplace or what the demand's going to be. We're eliminating some slower, older products. Will we lose those sales entirely, or will they switch over to a different product we're selling? So there's a lot of potential changes to the forecast based on how and what the company's doing and what their competitors are doing. So if your competitors are offering similar products at lower prices or more innovative products, that could eat into your demand as customers see that these other new companies are coming along, or existing competitors are coming along with a more compelling product. That can be an effect on your sales forecast as well. So the heart of it is, the more accurate your sales forecast is, the better your cash budget and pro forma financial statements will be. So in the preparing the cash budget, of course we start with the cash receipts. So that's going to be the first table. Think of the cash budget as a couple of separate tables. So the first table is going to be this total cash receipts. So when we're trying to put together a cash budget, we're going to begin with the total cash receipts and disbursements to arrive at a net cash inflow or outflow. And then that's going to be added to the cash balance. So the ending cash balance is going to be how much cash the firm's going to have on hand without seeking any additional financing. And this is what's going to tell us, financial managers, how much additional financing they're going to need. And it's part of the purpose of the cash budget is really to say, do we need to start borrowing money? Because if you need to borrow money, you can't do it in the month that you need it. You typically have to start that process earlier. So that's why we make these cash budgets, so we have a multiple month lead time to start borrowing the money that we're going to need in the future to keep our business running. Especially if it's a type of business that's cyclical, where maybe you're running a chain of movie theaters, which makes most of their money in the holiday period in December or the summer vacation period in the summer, and we have to manage our cash very closely in the months where we have a negative cash flow in this fall and spring. So starting with the cash receipts, we're going to look at the inflows of cash during a given period, usually a month. And we have to comprise cash receipts, cash sales, collections of accounts receivable, and other cash receipts. Now, they don't always land at the same time. So the estimated cash receipts, analysts have to kind of gather information from from a bunch of sources within the firm, including marketing, sales, and people accounting who oversees the collection, to get a better idea. So now, in any particular month, here's sort of a cash budget here, and what we're looking at: January, February, and so on all the way to December. This represents all the months between February and November. So we're going to get some money when we're looking at cash receipts. Now this is the cash budget, actually. So this is the cash receipts budget. But we're going to use this cash receipts budget to get to the cash budget at the end, where we take our total cash receipts, which is a separate budget that we're going to calculate, our total cash disbursements, our net cash flow, and then we're going to look at compared to our beginning cash, to the minimum cash we have to keep, which becomes our ending balance, excess or required financing. So we'll do more on this later. I want to get back to the cash receipts budget here. Okay. So in the cash receipts budget here, we have to remember that sales made in one month may not turn into cash that same month. So we have our sales forecast. So if you look at top, our first line here is the sales forecast. So we have our sales forecast, and this is basically what we're estimating our sales to be. Now, part of our sales forecast, we're saying here 20% of our sales forecast in the month of the sale will be collected in cash. So we can see 20% of 100 is 20, 20% of 200 is 40, 20% of 800 is 80. So right away, this is the type of business where we take 20% of all our sales to the cash register are cash. Then we have accounts receivable. So 50% of our sales will be collected in a month after they're sold, and then 30% will be collected 2 months after they're sold. So some people will pay in 30 days, some people will pay in 60 days. So if we have $100 here in sales, we collect $20 immediately in cash. Then 1 month later, September is 1 month later, 50% 1 month later. So 50% of 100 is 50. Then we're going to collect 30% of that 100 2 months later, September, October. So here's 30, which is 30% of 100. So this $100 in sales lands, the collections of this sales turning into cash land in August, September, and October. So you could see that any month, so October is the month here we're really starting our budget, and we can see that we collected $210 in total cash receipts in October, but we sold $400 worth of products on sales. But some of those products sold will not be collected until November and December. So we have this staggered collection schedule to represent that some people will pay in 30 days, some people will pay in 60 days. And then if we add up each month, we get our total cash receipts. Now here's going to be our cash disbursements. So this is stuff that we're paying. So typically anything we're going to purchase in cash, payments on accounts payable, rent, wages or salaries, tax payments, fixed asset outlays or payments, interest payments, cash dividend payments, principal payments on loans, and repurchase of stock or retirement or buyback of stock are all going to be disbursement. So a disbursement is a release of cash, a disbursement of cash. So when we look at disbursements, we start out with purchases. How much is the company going to purchase? So we're going to say that in any particular month, each schedule, each company has a different accountability here. So we're saying that our purchases are going to equal 70% of that month's sales. So if you remember, sales here were 100 and 200, so 70% would equal 70 and 140. So that's how we calculate our purchases. So it's an estimate of our sales. So what we're saying is, if we're going to sell $100 worth of bicycles, we need to purchase $100 worth of bicycle. 70% of that as bicycle inputs. So basically, we have a 30% profit margin there because the purchases or cost of our goods are 70% of the sales. So 10% now, when we purchase that, we purchase it on account. So we're saying that 10% will be paid for in cash, 70% will be paid in 30 days, so that's 70% of 70, and then 20% or 14 will be paid in 60 days. 1 month lag, 1 month lag, 2 month lag. So that's how we purchase on account. These are materials to make. These are the materials to make our products, and we pay for it in a staggered basis. So then we get to October, we have the cash payments of 10% from October, 70% from September's purchases, and then 14% from August's purchases. 20%, I'm sorry, for August's purchases. So this is what we paid in October. We paid $28 of October's purchases, $98 of September's purchases, and $14 of August's purchases. So it's lagged because we don't pay everything all back the same month that we borrow. So we're purchasing on account, and then we have a lag, a staggered payback of 1 to 2 months of paying that back. So what it's basically saying is some things that we buy, we have to buy for cash and pay for that month. Some vendors give us 30 days, some vendors give us 2 months or 60 days to pay back, and we take that time. So the $70 gets paid back. 7 plus 49 is 56. 56 plus 14 is 70. Okay. Now we also have, in some months, we might have rent payments. Well, every month we have a rent payment. And this must be in the thousands, so we'll say this is probably $5,000 a month in rent payments. And then we have wages and salaries that we pay that are fluctuating because we have hourly employees. So we might have some fixed salaries, and we might have some variable salaries. So these salaries might vary in the amount of actual work that's done, or the amount of monthly sales. We can sometimes put that in a percentage of monthly sales. Then we have fixed asset outlays. So we might have bought a piece of equipment in 1 month, but we don't do that every month. And we have tax payments. So tax payments are going to occur in December. And then we have interest payments, which are going to occur. These are going to occur in December. They don't occur every month. We may have cash dividend payments. Here are cash dividends. And then we have principal payments on the loan. So these are all the cash disbursements, the cash payments we're making in the month. Okay. So if we go back here, this cash receipts balance and this cash disbursement balance goes in the cash budget. This is where we put the cash receipts and the cash disbursements, and this would be the net cash flow. So for example, we'll go for October, cash receipts of 210, cash disbursements of 213. So we have a negative cash outflow that month because we have more. We're spending more than we're collecting. Okay, so if we look at this example here, typically when we're given move this up so you can read all this. This is how we typically would be given a cash budget problem, as it would be given as written out and as a word problem, generally stating, here we're stating that this defense contractor is developing a cash budget for October, November, December. The sales from August through September were, and they give us August through September because we need the previous month's sales to help figure out the total cash collected in October. So we're usually given some months of information, not for the purpose of completing the cash budget on those months, but just for the purpose of completing October, November, December. We're going to need August and September's information to complete these 3 months because of the staggered collection and disbursements. So it's saying that the sales were 100, 200, 400, 300, and 200 and have been forecasted for October, November, December. So basically, if we go back here, here is those same sales. These are actual. August, September are actual. October, November, December is the same thing that's listed out here, but we're putting the 3 zeros back, but they're forecasted. So 20% are paid in cash, 50% on accounts receivable after 1 month, remaining 30% after 2 months. Bad debt expenses, uncollectible accounts have been negligible, meaning that we're not going to even track it. In December, the firm will receive a $30,000 dividend from a stock in a subsidiary, and the schedule expected cash flow receipts for the company appear in table 4.8. So that is the table up here, 4.8. So we kind of reviewed that table already. And then they expect a rise from August to October before falling slightly in November, December. So that's our sales forecast. So then we have our cash sales for each month. That's a 20%. Collection of accounts receivable is a 1 month lag. And then the 2 month lag is a collection of 30% of the sales would be a 2 month lag. And there's some other cash receipts, which is basically this dividend. So if you see here, we have that broken out here, and here's that other cash receipt dividend here that they're specifying on this slide down here. All right. So the total cash receipts is going to be what we had put together earlier for those 3 months. So we're basically October, November, December. So if you look back here, we're forecasting just these 3 months. This is information we need in August and September to get the rest of this, to make a complete collection of cash receipts for October, November, and December. And then the cash disbursements is going to say the purchase is going to represent 70% of sales, 10% cash up front, 70% in 30 days, and the remaining 20% in 60 days. And then rent will pay $5,000 each month. Wages, so it specifies the wages, the tax payments, the fixed outlay, the interest payments, and that's all detailed here. So it's basically, when you get a problem like this, it's going to be a large word problem that you have to read over and then basically interpret to put into this problem. Just making this fit in a little bit better. Okay. That's how. So these problems can get quite large. So now, the cash dividend will be paid. The principal payments on loans. The repurchase of retirement stock, no repurchase of stock. So we see that all out here. We look at that $20,000 cash dividend in October, $20,000 principal payment in December. We see that here is $20,000 principal payment in December and the $20,000 cash dividend payment in October. So now preparing the cash budget. We're going to actually put these numbers, these two schedules, and we're going to look to calculate the net cash flow and the ending cash flow. So why it's important to prepare this cash budget is because the net cash flow, ending cash flow, financing, and excess cash, these are all things that we need to know. So required total financing. If we need to borrow more cash for the firm, we're going to need to know how much cash we need to borrow in advance. So that way we can start working on that and borrow it earlier. If we have excess cash balance, we can use that, to increase our investments or put that somewhere else if we have excess cash balance, or even pay back some of our loans or invest that money. So here's how that cash, here's a cash budget. So we bring in the cash receipts. This is from our first statement, October, November, December. And then we bring in our cash disbursements. If you remember before, I said there'd be a net cash outflow of $3 in October. So we have a negative cash outflow of $98 in November, and finally a positive cash inflow in December of $35. So following in October, our cash balance is $50. Ending balance is $47. So if we net the -3 and the $50, we get the $47. We have to maintain a minimum cash balance of $25. So the excess 47 minus 25 goes into marketable securities, or excess cash balance. Now, our ending balance goes to next year. So we bring in our cash receipts or cash disbursements, and we find out that we have an ending cash of negative $51 when we net these two together. So since we have to have at least a minimum of 25 in our minimum cash balance, we need to borrow 76 to get there. So we move over our ending cash balance here, and we see that we do have a cash net inflow of 35, reflected in our cash balance of negative 51, where now our ending cash is negative 16. We have to go from negative 16 to 25, so it's going to require 41 of additional financing. So if we're evaluating the cash budget, we want to look to see whether we're going to expect a cash shortage or a surplus in the months covered by the cash budget, because this is going to help us know whether to borrow or increase our bank lines, look for new sources of funding to fill that gap. And this is what's going to prevent the company from becoming insolvent or going bankrupt, is because we know that we're going to need cash in the future to bridge this period of time. We can borrow it ahead of time. Now, in some cases, the forecasting can be difficult because we don't really know where the economy is going, or we can't really rely on, how things are going to turn out 100%. We're not 100% sure. So we can conduct a scenario analysis to reflect the fact that most forecasts are usually wrong or have a variability of error. So we could prepare several cash budgets based on pessimistic, optimistic, or likely outcomes. So we could use these several cash budgets to develop really the worst case scenario, best case scenario, and the risks associated. So basically what we would do there is for each of the months, October, November, December, we would have a different forecast for pessimistic, most likely, and optimistic. So we could see in these three scenarios how the cash budget, the excess cash budget would be, or the required financing would be. So you see in the best case scenario, we wound up with an excess balance all 3 months. And in the worst case, we wind up getting actually pretty deep in cash requirements. So this way, if you're a financial manager, you say, okay, the worst case is that I'm going to need to require financing of 190, and it's probably 190,000. Yes, because it's in these three zeros up here mean add 3 zeros to each of these numbers. And we do that to make the grid overall smaller. So this $190,000 would need to be borrowed. So this scenario analysis helps us cope with the uncertainty of the cash budget, because no cash budget is going to be 100% correct. And that's why even in the simulation, when you see a cash balance and then the month runs and all of a sudden you have the cash deficit, how did that happen? Your pro forma financial statements were pointing towards surplus. But if you don't sell everything that you forecasted, these cash balances can quickly change, and surpluses can become deficits if the sales forecasts are not accurate. And that's why we can come up with a scenario analysis to better judge that. Now, because the cash budget shows cash flows only on a monthly basis, the information provided in the cash budget is not necessarily adequate for enduring solvency throughout the month. So the firm has to look closely at its daily cash patterns and receipts and cash disbursements to make sure that they have adequate cash the whole month. So even though, it could be a situation where 28 days of the month you're in a cash deficit, and it's only the last 2 days of the month where a lot of money rolls in to bring you to a cash surplus for the total month, but you still have to pay payroll and other things during the first 3 weeks, or the first, 2 weeks of the month. So that way you also have to have this idea that it's not just that month balance. You have to make sure you have cash to run every day of the month. So it makes an additional wrinkle. Now, what do we do with these sales forecasts? We can also use them to create a pro forma financial statement, similar to what is expressed at the end of the round when you're putting together your simulation results. They'll give you last year's financial statements and next year's pro forma financial statements, or basically, this is what we think how well you do next year based on the sales forecast or based on selling everything you forecasted. So it's going to be a projected or forecasted income statement and balance sheet. And we're going to work off of last year's financial statements to help create what next year's financial statements could be based on the sales forecast. So here we have an income statement for a company. And it's going to break out what they sell all the way down to their retained earnings. So this is just a regular income statement. Here's a regular balance sheet for the company. So if we're going to forecast, the forecast for the year, so if we go back here, we see that it's 1,000 mugs, 1,000 plates. If we're going to forecast 1,500 mugs and 1,950 plates, this is what we think we'll sell next year. we can figure out by the sales per unit what our total sales would be for next year. So then we can calculate a percentage of sales method. So we could say that cost of goods sold is generally based on last year's information, 80% of sales. Operating expenses are 10% of sales, and interest expense is 1% of sales. Then we could use this percentage of sales method. We put these percentages in, and we take next year's sales, and we calculate by multiplying by 80% the new cost of goods sold, and that minus sales is our gross profits. Multiply our sales by 10%, that's our new operating expenses. By 1%, that's our new interest expense. So we can recreate the income statement based on a percentage of sales method, saying that, these items work in the same percentage of sales no matter whatever sales could be. So if we know the new forecasted sales amount, we can calculate the new pro forma income statement. So the major weakness to this approach is that it's going to lie in two assumptions: that the past financial performance is going to be replicated in the future, and certain variables like cash, accounts receivables, inventories can be forced to take on those desired values, or those percentage values. And these assumptions, while maybe somewhat accurate, are not always going to be 100% accurate in the calculations. In reality, could be off, could not be as accurate. However, those pro forma financial statements are going to be very useful for analysts determining most likely where the company is going to be and making financial decisions whether or not to lend money to this company, to buy the stock. So these financial statements, we can utilize these to create financial ratios to look at next year's estimated financial performance compared to this year's estimated financial performance. So if we're trying to analyze the inflow and outflow of cash and the level of debt and equity and profitability of the company, we could kind of see, is it worth it? Is the valuation of the company today going to be similar or more next year based on how sales are changing? Now, so you have to understand that when these pro forma financial statements are prepared, they're not 100% going to be realized. So that's why when you, at the end of the round, you look at your pro forma financial statement, you see your profits, your sales, your cash surplus, that may not be the actual, and usually isn't the actual result when the round is processed. So the same thing with these pro formas. When the year is actually done and you look back and you calculate your actual financial statements, they're most likely not going to match your pro forma, although they oftentimes come very close. So, when you're analyzing the cash inflows and outflows, this can be helped by creating a pro forma financial statement, pro forma income and balance sheet statements. Then you can create a statement of cash flows of what your likely cash flow scenarios will be next year. And this will help financial managers to better adjust their short-term goals to meet their long-term goals by putting together these schedules. So it's a difficult thing, these pro forma financial statements, because we're assuming that the techniques we're using, we have to make certain assumptions about certain costs and expenses that may change. For example, prices for electricity or energy or employment. There could be a change in minimum wage laws. There could be a change in inflation. They're going to change a lot of the expenses that we just can't predict right now. Commodities can be very fickle. If you're using oil, sugar, natural gas, different commodities in your production, those can go up dramatically. If your raw materials are being controlled from other markets, so maybe they're being controlled in a less competitive market or it's subject to shortages, there could be wild swings in what the cost of your production could be. These are all things that can't always accurately be forecast in preparing these pro forma financial statements. So, but it's better than nothing. So it's important to invest in the evaluation of these pro forma financial statements to see what did we get right, what did we get wrong, what could we do next year to make these financial statements more accurate. Because no one's a financial fortune teller. They can't, predict everything that's going to happen next year. So there are, important things that, may come up all of a sudden. Expensive piece of equipment breaks and needs to be fixed, or there's a strike, a labor strike. These are things that could happen that could really affect your product. Or there's some kind of new report or scientific information that says your product might be hurtful. Or maybe there is a defect in your product that you could be sued for hurting people. So there's all these things that could come up that could throw a wrinkle in your sales forecast, in your cash flows. But financial managers need something to work off. Best case scenario that the pro formas are pretty accurate or pretty close, they can better manage the company and analyze the performance of the company. If historically the pro forma financial statements have been difficult to produce with extreme accuracy, they can have bigger cash accounts to hold a larger variability of outcomes. Just like in the financial simulation you're running, if you're repeatedly having these cash deficits that were unexpected, maybe keep a bigger cash balance. Instead of keeping a $10 million excess cash balance, keep a $50 million excess cash balance to make up for your inaccurate sales forecasting and your inaccurate pro forma financial statements, to compensate for the fact that things could change wildly based on what competitors are doing, based on the inaccuracy of your forecasts, so that way you have a better chance of meeting the company's goals and, focusing on planning for the company's future. Okay, that's the end of part 2 of chapter 4. I look forward to talking to you in chapter 5.